back to Economic Insights. I'm Alex, and joining me as always is our show's producer and resident market veteran, Selim. Selim, this was not a normal week.
There have been no normal weeks lately, Alex, but this one was something else entirely. Let me put it plainly. The world agreed to release 400 million barrels of emergency oil reserves, the largest coordinated reserve release in recorded history, and oil still closed the week above $100 a barrel. That one sentence tells you everything you need to know about what we are dealing with.
Let's walk through what happened. How did we get here?
The week opened with oil already above $100. Brent had spiked to intraday highs $119 at the peak. The escalating conflict with Iran and the effective closure of the Strait of Hormuz all hit Asian equity markets particularly hard. South Korea's main index fell over 8% in a single session. Japan's Nikkei dropped around 7%.
That's a massive move in one day.
It is. And it was accompanied by an equally aggressive repricing of interest rate expectations. Markets went from pricing in meaningful rate cuts from the Fed this year to pricing in almost none, with a non trivial probability of a rate hike briefly appearing in options markets. A rate hike from the Fed was, until recently, considered science fiction.
Then things briefly calmed down midweek.
Tuesday brought a sharp reversal. President Trump suggested the war could be over very soon. Saudi Aramco announced it would reroute crude through its Red Sea pipeline, bypassing the strait. Oil fell sharply, briefly back below $90. Equity markets staged a strong recovery. Tech got an extra boost from Oracle's earnings, which signaled that AI infrastructure spending is still roaring. For about 24 hours, people exhaled.
That didn't last.
No. Fresh attacks on oil tankers, Iraq halting operations at its oil ports, and then the IEA officially announcing the release of 400 million barrels from emergency reserves, including 172 million from the US alone, and oil still rallied back toward $100 and through it. Markets took one look at the reserve release and decided it wasn't enough, which mathematically it isn't, because you are facing a potential shortfall of 12 to 16 million barrels a day. A reserve release drawing down at 1.2 million barrels a day doesn't close that gap.
And then the geopolitics got even more serious to close out the week.
Significantly more serious. Iran demanded future security guarantees as a precondition for any ceasefire, which investors interpreted as a signal that this conflict is going to run for a while. Ceasefire prospects moved from hopeful to distant. European and US sovereign bonds sold off hard as traders priced out rate cuts. The market's way of saying prolonged war, prolonged inflation, prolonged higher rates. And then early Saturday morning, US forces struck Kharg Island. That is Iran's primary oil export terminal. It handles approximately 90% of Iran's crude shipments. Iran's response was to issue threats against all US interests in the region. And in the UAE, an intercepted drone caused a major fire at the Fujairah port. The UAE has been hit repeatedly this week with escalating intensity.
And Turkey?
Turkey received 3 Iranian missiles this week. That is a significant escalation. NATO territory is now being struck. The geopolitical implications of that extend well beyond oil markets. And separately, late in the week, there were signs of serious stress in the private credit market. Firms began capping investor withdrawals after a spike in redemption requests. When you see that, it tells you the anxiety has spread from public markets into corners of finance that are harder to see.
Let's go through developed markets. What's the state of the US economy right now?
Complicated. The underlying data heading into this week wasn't bad. Q1 GDP is tracking around 3.1% to 3.2% annualized, which is solid. The trade deficit narrowed sharply. Housing starts were strong. But the jobs report told a different story. The economy is not collapsing, but it is not generating the kind of employment you'd expect at 3% growth. Meanwhile, the Fed's preferred inflation measure, core PCE, is tracking near 0.4% month on month, which keeps the year on year rate above 3%. So you have decent growth, stubborn inflation, and a weak jobs print. That is the stagflation setup in embryonic form, even before geopolitics came into the picture.
And what does the Fed do at next week's meeting?
They hold. That is essentially certain. The interest is in the tone. The Fed's updated projections are expected to show upward revisions to inflation for this year, while the median forecast, the so called dot plot, is likely to still show only one rate cut in 2026. Chair Powell will walk a careful line, acknowledging the upside inflation risk from energy without panicking anyone into thinking a hike is coming. Rate hikes would require core inflation accelerating structurally above 3% and the labor market retightening sharply. Neither of those conditions exists right now. The base case remains a hold, with the first cut pushed back. Some forecasters now expect September at the earliest. Others see no cuts at all this year.
Europe is in a tougher spot than the US here, isn't it?
Much tougher. The Eurozone imports roughly 70% of its energy, so every dollar on the oil price is a direct hit to European consumers and to European competitiveness. Growth forecasts have been cut. Germany specifically went from an expected 1.5% growth this year to 1.0%, and that was before the latest escalation. Italian officials tried to invoke the EU's emergency fiscal escape clause, citing oil prices near $120 a barrel, and Brussels said no.
And the ECB?
The ECB is expected to hold rates at its next meeting, but the tone has turned hawkish very quickly. Markets are now pricing in the possibility of ECB rate hikes later this year if energy prices remain elevated. The challenge, and this is the painful irony, is that hiking rates during an energy induced recession would destroy demand and could push the Eurozone into something much worse. So the ECB is in an extremely difficult position: raise rates to fight inflation and risk a recession, stay on hold and risk inflation expectations drifting higher. Neither option is good.
What about the UK?
The UK is caught in the same trap with some uniquely British complications. Growth has effectively stalled. January GDP was flat. Inflation is projected to peak somewhere between 2.7% and 3% this year. The Bank of England holds next week at 3.75%, almost certainly with a 7 to 2 vote. Rate cuts have been pushed back into the second half of the year at the earliest, and that assumes the energy shock doesn't get worse. The one thing analysts broadly agree on is that rate hikes are unlikely, the labor market is loosening, growth is stalling, and the starting rate is already restrictive. It's not 2022 all over again, even if it feels uncomfortably similar.
Japan. Complicated picture there, too.
Japan is in a genuinely unusual position. Before this conflict escalated, the economy was finally showing some good news. Growth was revised significantly higher. Real wages turned positive for the first time in over a year. Wage negotiations this spring are on track to exceed 5% increases for the third year running. For a country that spent decades fighting deflation, that is meaningful progress.
But the yen is suffering.
The yen is suffering precisely because Japan imports virtually all of its energy. Higher oil prices widen the trade deficit, which weakens the currency. The yen is sitting near 160 to the dollar. Normally, in a global crisis, the yen gets bought as a safe haven. Not this time. Broad dollar strength is overwhelming that dynamic. The Bank of Japan holds next week at 0.75%. The probability of an April hike has fallen below 50%, with oil above $100. June is now the more likely timing. If crude stays elevated, even that would be uncertain. And the government is caught between wanting to maintain energy subsidies to cushion consumers and facing increasing US pressure to boost defense spending. The summit between the two countries is also next week.
Turning to the FX markets. The dollar playing its usual crisis role?
Unambiguously, the US benefits here from being a net energy exporter. Higher oil improves American terms of trade while hurting nearly everyone else. The dollar is tactically the defensive hedge of choice. The euro faces clear downside from its energy dependence. Sterling has repriced somewhat on the expectation the Bank of England won't cut, but it remains vulnerable. One analyst described the UK's position as a toxic combination of fiscal and political risk. The The Swiss franc is strengthening on safe haven flows enough that the Swiss National Bank is signaling willingness to intervene to weaken it,
Gold?
very much the hedge of choice alongside the dollar. The rationale is straightforward: energy driven inflation, fiscal concerns, uncertainty about central bank credibility. Gold ticks all of those boxes simultaneously.
And the oil picture specifically, you mentioned production shut-ins. Give me the scale of this.
The numbers are staggering. Production shut ins have reached 6.5 million barrels per day already, and estimates suggest that could approach 12 million barrels per day as the crisis continues. Global supply was already short by roughly 7 million barrels per day before the latest strikes. Kharg Island handles 90% of Iran's oil exports, so the Saturday morning US strike is not a minor event for the oil supply balance. The SPR release of 400 million barrels sounds large until you realize you are drawing down against a potential shortfall that could reach 12 to 16 million barrels per day. The math simply doesn't work as a price solution. It buys time, not resolution.
What about beyond oil?
The conflict is cascading through commodities broadly. Qatar declared force majeure and halted LNG production. That removes roughly 20% of global LNG supply from the market. Diesel in Northwest Europe has climbed to $140 a barrel, jet fuel to $175 a barrel. Airlines have already started adding fuel surcharges. Urea fertilizer prices are up 60% since the war began because the Middle East is a major source of global fertilizer exports. Food inflation is now a very real downstream consequence of what is happening in the Strait of Hormuz.
Emerging markets. Who is most exposed and who has some protection?
It very much depends on which side of the oil equation you sit on. Let's start with China, because China is holding up better than most. The country has strategic petroleum reserves estimated at 110 to 140 days of imports. Domestic price controls limit how much of the global oil shock passes through to consumers. Exports surged in February, up nearly 40% year on year. And the Chinese yuan is actually seen as a relative haven in this environment, precisely because of that lighter oil dependence. The government has ordered major state refiners to halt diesel and gasoline exports to prioritize domestic supply, which is a sign of the pressure but also of the capacity to manage it.
India is more exposed.
Significantly more. India gets roughly 40% of its crude oil and 80% of its gas from the Middle East. The growth forecast has already been cut to 6.5% for this year. The currency is under pressure. The government has frozen retail petrol and diesel prices to cushion consumers, which costs money. The fiscal deficit target is at serious risk. The central bank is expected to hold rates and will stay active in currency intervention. India has substantial foreign exchange reserves, but the balance of payments pressure is real and sustained.
Turkey. They've had a uniquely difficult week.
Understatement of the year. Turkey is a net energy importer, already running inflation around 31% after the extraordinary disinflation effort of the past 2 years, still far from normal. 3 Iranian missiles struck Turkish territory this week. That changes the risk perception for foreign investors in Turkish assets immediately and dramatically. The central bank held its headline rate at 37%, but delivered an effective 300 basis point indirect hike through its open market operations, a technical mechanism, but one that pushed corporate lending rates sharply higher. And the foreign exchange reserves have taken a serious hit. Net reserves fell by roughly $26 billion since the conflict began. The sharpest single-day drop was $13 billion. Usable reserves are now around $62 billion, which analysts view as a sufficient buffer, but only just.
Is there a path where Turkey gets through this?
There are 3 paths, and they all depend on the war. If the conflict is contained and oil falls back below $80, the central bank resumes cutting rates and things normalize. If uncertainty drags on and energy stays elevated, rates stay high for much longer. There's no room to ease. And if the war worsens and reserves erode further, Turkey may need to formally hike rates. The government has deployed a sliding scale fuel tax mechanism to offset up to $105 per barrel of crude. Beyond that, the fiscal shield runs out.
South Africa?
South Africa is an energy importer, so it's under inflation pressure from the oil shock. But it has a partial offset that's unique to it: elevated gold and platinum prices, which benefit the country significantly as a major producer of both. Rate cuts are off the table for the near future given the inflation risk, but South Africa is not in crisis territory.
Egypt?
Egypt is under real pressure. The pound has weakened more than 10% amid the Middle East volatility. Portfolio investors have been selling local treasury bills. The government responded to rising global energy prices with a 16% hike in domestic fuel prices. That feeds directly into inflation, which was already accelerating. February CPI hit 13.4%. The carry trade that made Egyptian assets attractive to foreign investors is now facing clear headwinds. The silver lining is that Egypt has built up meaningful reserves. Foreign exchange reserves around $31 billion plus substantial gold holdings. That's the buffer between pressure and crisis.
And the Gulf states themselves? They're in the middle of all this.
Literally in the line of fire, and also in some sense the economic winners. The UAE has suffered drone strikes, resulting in fires and the shutdown of the Ruwais refinery as a precaution. But they also have infrastructure that bypasses the strait entirely: the Abu Dhabi crude oil pipeline and Fujairah oil terminals, which also saw an intercepted attack. Saudi Arabia can reroute flows via its Red Sea pipeline. The whole region is absorbing direct operational and infrastructure damage while simultaneously benefiting from oil revenue at historically elevated prices. It is not a simple equation for any of them.
What does next week look like?
Next week is being called Central Bank Week, and that label is entirely justified. On the 18th and 19th of March, we have the Fed, the Bank of Japan, the Bank of England, the European Central Bank, the Swiss National Bank, the Reserve Bank of Australia, the Bank of Canada, the Brazilian Central Bank, all making decisions within roughly a 48-hour window. It is extraordinary.
What are the key decisions to watch?
The Fed holds, almost certain. The interest is in Powell's press conference and the updated projections. The Bank of Japan holds at 0.75%. Governor Ueda's commentary on oil, inflation, and the yen will be parsed very carefully, and Japan's spring wage negotiation results drop the following week, which matters enormously for whether the BOJ can eventually resume hikes. The Bank of England holds at 3.75%. The ECB holds but with a hawkish tone. Australia is the outlier. It's expected to hike 25 basis points to 4.1% because domestic inflation remains elevated and the economy still has limited spare capacity.
Any other events to watch?
China releases a slew of data. The US-Japan summit takes place on the 19th, where the US is expected to push Japan to increase defense spending. That adds fiscal pressure to a government already managing energy subsidies and a weak yen. And of course, whatever happens in the Middle East over the next 7 days will move markets more than any central bank statement. The situation around Kharg Island, the UAE, the Strait of Hormuz, these are the variables that overshadow everything.
The war remains the market.
The war is the market right now. Every signal from that region will be reflected instantly in oil, rates, equities, and currencies. We will be watching it closely, as we have been for the past several weeks.
Selim, thank you. Another week that redefines what we thought was possible.
And next week has at least as many ways to surprise us.
Don't forget, folks, we do not give investment advice. For that, please consult a professional. We will be taking a break next week. Until next time.